This podcast includes content created using artificial intelligence tools. All information is for general purposes only and does not constitute financial, investment, legal, or regulatory advice. Listeners should verify information independently and consult qualified professionals for personalized guidance. Welcome to the Luxembourg Fundcast. Before we continue, we'd like to mention that the Luxembourg Fundcast is created and produced by Bertrand Mario, a regulatory lawyer qualified as avocat à la cour in Luxembourg and Paris. The mission of this podcast is to bring clear, free, and reliable information sourced from official references that are carefully curated and continually updated and refined through high-standard, evolving prompt and context engineering on Luxembourg's financial regulation and investment funds to professionals and anyone interested in the Luxembourg Financial Center. Welcome back. We're doing a really necessary deep dive today. We're going to be looking at the landscape for private debt and investment funds here in Luxembourg.
Which has been, let's say, pretty dynamic.
That's one word for it. And just to set the scene for everyone, our analysis is based on everything we know as of December 1st, 2025.
That's right. And the big story is really the consolidation of two major laws into the law of the financial sector, the LFS.
Right. So we're talking about the combined effect of the law from July 2024, which was the NPL directive.
And the law from July 2025, which finally brought in the Listing Act changes.
Exactly. And our mission today is to go a little deeper than just, a compliance update. We want to look at how these shifts around credit servicing, capital markets, and, of course, tax are creating some real strategic opportunities.
I think that's the right way to frame it. And to help with that, we've sort of boiled it all down to four key takeaways, four things you really can't ignore.
Okay, let's have them. What's number one?
First up is the credit servicer license. This is a big one. Managing non-performing loans, NPLs, from EU banks is now a fully regulated PFS activity.
A professional of the financial sector.
Exactly.
Yeah.
And the really crucial point here is that the transitional period for companies already doing this, well, that expired way back in mid-2024. This isn't coming, it's here.
So, no excuses.
Yeah.
Got it. What's number two?
Capital market simplification. This is all about making it easier to access capital. The Lifting Act has pushed the prospectus exemption threshold way up.
I remember hearing about this. It's up to 12 million euros now.
12 million euros. It's a significant change.
Okay. And number three?
Number three is about tax efficiency for the managers themselves. We're all watching Draft Law 8590.
The carried interest bill.
That's the one. It's still a draft, but it's signaling a very competitive regime. We're looking at an effective tax rate of around 11 to 12% on contractual carry. The expectation is for it to kick in from the 2026 tax year.
That will certainly make some waves. And the final point.
And finally, a bit of certainty that's already locked in. Bill 8414 was adopted last year, and it clarifies the interest deduction rules. This is a huge relief for standalone securitization vehicles, the SPVs. It takes a big dry tax risk off the table.
Okay, that's a great roadmap. Let's dive into that first point then. The crystallization of credit servicing as a regulated activity.
Right. So this really changes the game in the secondary debt market. The Law 15, July 2024, basically wrote the credit servicer status directly into the LFS.
And that's under Articles 2814 to 2818, if I recall.
That's it. So the scope is quite specific. It's for servicing non-performing credit agreements that were originally issued by an EU credit institution.
So that would cover things like collecting payments, renegotiating terms, handling complaints. But the key question for a fund manager is, how do I know if I need this license?
And that is the absolute core distinction. If you're a loan origination fund and you're just managing the loans that you yourself created, you're generally out of scope. But the second your fund goes out and buys a portfolio of NPLs from a bank, a secondary market deal, you are now directly in scope. Either the fund or whichever entity is servicing those loans on its behalf has to be licensed by the CSSF. No way around it.
That adds a pretty significant layer of regulatory diligence when you're looking at buying these portfolios. And I see there's a two-tier capital system depending on who's holding the cash.
Yes, that's right. The LFS is quite clear. If you're a servicer who never actually holds borrower funds, you're looking at 75,000 euros of paid-up capital. That's Tier 1.
And if you do hold the funds,
then you're in Tier 2. The capital requirement doubles to 150,000 euros.
And for those Tier 2 servicers, it's not just about having more capital, is it? There's a big protection requirement.
A critical one. They must keep any borrower funds in a totally separate account at a bank. And the legal way of that is huge. It means those funds are shielded from the servicer's own creditors if they go bust. It's a powerful consumer protection measure.
Makes sense. Now, beyond capital, the rules seem to really zero in on documentation, specifically the credit servicing agreement, the CSA, between the fund and the servicer.
Oh, absolutely. That agreement has to be incredibly precise. It needs to detail the scope of work, how remuneration is calculated, the limits of the servicer's authority, you name it.
What's the biggest tripwire in that agreement for a compliance team?
It's procedural, and it's a classic one. The servicer must notify the purchaser, so the fund, before it outsources any of its activities. Forgetting that prior notification, even by accident, can cause a major compliance headache.
And then we get to the really big one, that mandatory clause about fair and diligent treatment of borrowers. This feels like where abstract conduct risk becomes very real for the fund manager.
This is exactly where you move from a compliance task to a strategic risk. That fair treatment clause is a long-term operational risk. Suddenly, your due diligence on a servicer has to go way beyond their balance sheet.
You have to look at their complaints process, their consumer policies.
All of it. A failure by the servicer here could lead to some really hefty fines. And that's why any smart debt fund will now demand robust indemnity clauses in that CSA.
So if the servicer messes up and gets fined, they're the ones who pay.
Precisely.
Right.
You link the fund's regulatory exposure directly to the servicer's operational performance. It's a non-negotiable point in any negotiation now.
That definitely complicates the selection process. And just quickly, if a fund decides, you know what, we'll just do this in-house, what's a realistic timeline to get that CSSF license?
Well, the CSSF has a 90-day statutory deadline to make a decision, but that's only once the application file is deemed complete.
And getting it complete takes time.
Right. There's a 45-day review period for that, plus all the prep work beforehand. Realistically, you should budget for a 6 to 9 month process, end to end. And I'll say it again, the transition period is over. This is a current compliance issue, not a future one.
Understood. That urgency brings us nicely to our second point, the Listing Act. This feels like a shift in the other direction, from adding regulation to, well, removing some of it to spur activity.
It's a very deliberate market intervention, yes.
Yeah.
The whole goal of the law of 3 July 2025 was to streamline the funding process. And the headline change is definitely that prospectus exemption.
So we're moving the threshold for a full EU prospectus up to 12 million euros, calculated over a 12-month period. For our listeners in private debt, what's the immediate practical benefit?
The benefit is flexibility. 12 million euros is the sweet spot for what you might call mini bonds. Before, the legal and compliance costs of listing a smaller debt tranche, say 5 or 10 million, were often prohibitive.
You'd wipe out the benefit.
Exactly. Now, a fund can bring smaller tranches to market quickly and cheaply. Maybe to fund a specific mid-market acquisition or just to test the waters with investors. It just massively accelerates the time to market.
I see the direct line to issuance there. But the Act also had a more subtle change, didn't it? Something about the MiFID rules on research.
It did, yes. And this is about the health of the secondary market for that debt once it's issued. It rolls back the very strict unbundling rules that MiFID brought in.
So portfolio managers can now rebundle payments for trade execution and research again.
They can, provided there's a written agreement and it's disclosed to clients.
Why is that so important for a private debt fund? It seems a bit indirect.
The logic is purely economic. The strict unbundling made it, frankly, uneconomical for many firms to provide research coverage on smaller and mid-cap issuers. There just wasn't a viable business model.
Right.
By allowing rebundling, the hope is that more research gets produced. More research means better price discovery and more liquidity for these listed debt instruments. And that ultimately benefits the fund's investors because it creates a more transparent and active secondary market for their holdings.
I see. It's a regulatory tweak with a direct economic consequence. Okay, let's pivot to the foundation of all of this tax.
Right.
Let's start with what's already been adopted, Bill 8414.
Yes, this was a really important fix. It was voted on in December 2024. And it solved a major potential tax headache related to interest deduction limits.
And this was a particular problem for standalone securitization vehicles, the SPVs, right? Why were they so exposed?
Their exposure came from the general rules, which limited interest deductions. The problem was that the main escape hatch from those limits was a group-level equity ratio test.
And a standalone SPV isn't part of a group for tax purposes.
Exactly. So they were stuck. They couldn't use the escape clause, which created this risk of dry tax, having a tax bill, even when their income was fully offset by financing costs. It was a structural flaw.
So how did the single company worldwide group clause fix this?
It's a clever technical solution. It essentially allows the standalone SPV to be treated as if it were part of a group, just for this one calculation. So it can now compare its own equity-to-asset ratio against a theoretical worldwide group average.
And if it meets the test, it gets full deductibility.
Full deductibility. It safeguards the entire model for these vehicles. It was a critical piece of legislation.
Okay, that secures the structures. Now let's talk about securing the talent. Bill 8590, the carried interest bill, which we're expecting to see in force for the 2026 tax year.
This is the one everyone is talking about. It's a massive, strategic move to attract and retain top managers. It takes the whole framework out of administrative circulars and puts it on a solid legal footing.
And it proposes two main routes, correct? Let's start with the contractual carried interest.
Right. So this is for the manager who gets carry as compensation but maybe hasn't put their own capital in. That income is set to be taxed at 1/4 of the global rate.
Which works out to an effective rate of what, around 11 or 12%?
Roughly 11 to 12%, yes.
Yeah.
Which is obviously much, much lower than standard income tax rates.
And how does that compare with the other option, the participation-linked carry?
That's even better, but the bar is higher. This is for the manager who does have a real equity stake in the fund. If they hold that stake for more than 6 months, and it's less than 10% of the total fund, the carry is completely tax exempt.
So 0%.
0%.
Having a 0% option next to an 11 to 12% option seems like a very powerful combination. How does this position Luxembourg against, say, the UK?
It creates a fantastic USP, a unique selling proposition. In the UK, carry is often treated as a capital gain, but the rate can be a bit of a political football. What Luxembourg is doing is enshrining a very low and very certain legal rate. That certainty is gold for attracting top-tier global talent in private equity. It really cements Luxembourg's position.
It's a compelling package. Okay, so we've covered the big changes. Let's pull it all together. For the professionals listening, what's the strategic play now as we head into 2026?
It's time to shift from just thinking about compliance to actively optimizing. And we see 3 immediate action points.
Okay, action point 1.
The documentation audit. Go back and review every single one of your existing MPL servicing agreements right now.
And you're looking for those key clauses, the fair treatment and outsourcing notification clauses?
You have to. You need to ensure they are explicitly there and that they're compliant with the 2024 law. Any gaps there are a legacy risk just waiting for an auditor to find.
Makes sense. Action point 2.
Structural planning. Sit down with your team and seriously analyze how you can use that new €12 million prospectus exemption. Could you design a master feeder fund, for example, with a feeder tranche that specifically targets retail investors using these cheap, fast mini bonds? It's about innovating your product.
A new way to access capital. And the final action point.
Talent retention. Don't wait for Bill 8590 to be formally voted into law. Start building your remuneration policies now. The fact that this competitive carry regime is coming in 2026 is a powerful recruitment and retention tool that you can use today.
Great. So to quickly recap the whole deep dive then, first, an urgent call to action. Verify that your secondary market debt servicers have the right credit servicer license today.
Second, that €12 million prospectus exemption is a green light for faster, cheaper, and more innovative ways to raise capital from the public.
And third, the tax picture looks incredibly strong. Bill 8414 has secured the structures, and Bill 8590 is poised to make Luxembourg one of the most attractive places for managers to be from 2026.
And maybe, as a final thought for you to chew on, given this really high regulatory bar for credit servicers, the capital, the 6 to 9 month timeline, how is this all going to reshape the NPL market itself?
What do you mean?
Well, will the high cost and complexity push all the smaller independent servicers to consolidate into a few big players? Or will we see the opposite? Will the big private debt funds decide it's better to just bring all these capabilities in-house to have total control over the operational and regulatory risk? It's an interesting question of market structure.
This podcast is a collaborative and free resource that improves continually, so your comments or requests for new topics are highly welcome, especially on YouTube. We want to be a helpful strength for everyone working in the Luxembourg Financial Center at all levels. We are often asked how you can help us. Well, a great way to help is by subscribing to our shows on all major podcast platforms, including Spotify, as well as on Apple Podcasts, where a 5-star rating would really help us. You can also like our videos and subscribe to our YouTube channels, Rigore Media, and Bertrand Mario, a UX blog. We also invite you to follow or connect with Bertrand Mario on LinkedIn and to like and comment on our posts there. All relevant links will be available in the show notes. It was the Luxembourg Fundcast for you today. This podcast includes content created using artificial intelligence tools. All information is for general purposes only and does not constitute financial, investment, legal, or regulatory advice. Listeners should verify information independently and consult qualified professionals for personalized guidance.